Right now, something massive is happening in the silver markets, and almost no one in mainstream financial media is reporting it. The Shanghai Futures Exchange just saw 15% of its silver vault inventory disappear in a single trading day. Let me stress that again. 15% of all available silver in Shanghai vanished in just 24 hours. This isn't speculation. This is official exchange data. At the moment, Western spot silver sits at $73 per ounce, while Shanghai spot trades around $76, and Shanghai futures are pushing toward $80. That's a premium of roughly 3.5 to 5% for silver in China compared to Western exchanges. And in the world of commodities, that small difference creates massive ripple effects across global supply chains. Before we dig deeper, I want you to share in the comments where you're watching from today. Are you tuning in from the US, the UK, Canada, Australia, Singapore, Germany, India? The way the situation is unfolding depends heavily on your location, and some markets are showing signs others aren't. Here's the story. China has effectively created a silver black hole. Three major forces are converging to create a severe physical supply crunch that paper markets cannot fix. The first is industrial demand, especially from solar and electric vehicle production. China's photovoltaic sector is expanding rapidly, and demand for silver is growing faster than most people realize. Even though silver has fallen from highs near $116 per ounce down to $73, manufacturers are seeing this as a chance to stockpile. They aren't gambling, they need silver to run their production lines in 2026. To put it in perspective, solar panel manufacturing alone consumes between 20 and 30 million ounces of silver annually, while electric vehicle components take another 15 to 20 million ounces. Paper futures prices don't matter to these buyers. What matters is having physical silver in hand when the factory doors open. Right now, every ounce is being fought over aggressively. The second force is the Shanghai premium, which is acting like a global magnet for physical silver. A 3.5 to 5% premium may seem modest, but in commodity markets, that's a massive incentive. Physical silver is flowing into China from all over the world, and it's happening fast. If you could sell silver for 5% more in Shanghai than in New York or London, where would you send it? East, without hesitation. This arbitrage is pulling global inventory toward China at an unprecedented pace. The third force is export restrictions. Since January 1, 2026, China has introduced strict licensing rules for refined silver exports. These aren't minor bureaucratic changes. They are a structural shift in how silver moves across borders. Silver can enter China relatively easily, but leaving the country has become extremely difficult. The result is simple. Supply is trapped within China, while domestic demand continues to drain inventories rapidly. When you combine these three forces, rising industrial demand, Shanghai premiums pulling silver eastward, and export restrictions preventing outflow, you get a one-way valve. Silver flows in, but it cannot flow back out. Inventories are draining, and while paper prices remain suppressed, physical markets are signaling an acute shortage. Turning to COMEX, the March 2026 delivery period is fast approaching, and the numbers show the system is under serious strain. Registered silver available for delivery is 103 million ounces, while open interest across futures contracts sits at 429 million ounces. That's a leverage ratio of 416%, far beyond historical norms. Normally, open interest is backed by 15 to 20% coverage of registered silver. Right now, 76% of contracts have no physical backing if holders demand delivery. March delivery begins February 27, 2026, just weeks away. Inventory is already being drained at a rapid pace. Reports show 785,000 ounces leaving registered vaults daily, which means if this trend continues, the supply could drop to 85 million ounces or lower by the time delivery starts. January 2026 already showed extreme demand. Nearly 100% of open interest demanded physical delivery in some contracts, far above the historical 5 to 20%. If March delivery demand reaches 25%, we would need 107 million ounces against only 85 million available, and if demand hits 50%, over 200 million ounces would be required. The math doesn't add up, and the system is under stress. Last week, the Shanghai Futures Exchange reported that 6 linked account groups exceeded intraday position limits, dumping roughly 674 million ounces of paper silver in a single morning session. That's nearly double annual global mine production. The exchange acted quickly, banning the accounts and confirming this was a coordinated attack. Why would anyone attack prices at a time when physical inventories are already under stress, premiums are rising, and industrial demand is accelerating? The beneficiaries are likely short holders or entities trying to cover short positions at lower prices. Retail investors watching the paper price collapse gain nothing. Meanwhile, physical demand continues to accelerate, widening the gap between paper prices and real scarcity. On COMEX, 3 million ounces of physical silver were withdrawn in a single day, with settlement rates hitting 100% physical delivery compared to the normal 1 to 3%. Total inventory is dropping toward 400 million ounces. Paper markets are suppressing prices, while physical markets are draining inventory. This happens when synthetic supply collides with real-world demand, putting serious stress on the system. Where do you think this ends? Comment below with your predictions. Will COMEX navigate March delivery without disruption, or will we see settlement failures? Your insight is valuable because this community often spots details that might otherwise be missed. Meanwhile, China's central bank has now extended its gold buying streak to 15 consecutive months, adding 40,000 troy ounces in January 2026. Central bank purchases signal institutional confidence in hard assets, and historically, gold and silver move together during periods of monetary stress. When central banks buy, they're signaling mistrust in paper alternatives. The silver-gold ratio shows silver underperforming gold, which is closely tied to Bitcoin's performance during risk-off periods. Crypto markets are down, risk appetite is weak, yet physical demand in Singapore, Australia, Thailand, and China is rising despite lower paper prices. This divergence is critical to understand. The largest silver-backed ETF recently traded $41 billion in a single day, more than any individual stock globally. That kind of volume shows violent position changes, forced liquidations, and capitulation, exhausting weaker market participants. The CME has now implemented 3 margin increases in 10 days, 20% for silver and 11% for gold. Exchanges do not raise margins lightly. These are emergency measures. Traders without sufficient capital may be liquidated, while short positions face higher maintenance requirements. This is a clear signal that silver positioning is dangerously concentrated. Industrial users, however, are not waiting for paper markets to stabilize. They're transitioning from just-in-time inventory to strategic stockpiling. Solar panel and EV factories cannot afford halted production due to delivery failures. Companies are extending inventory targets from 30 days to 90 to 120 days, signing long-term contracts directly with mines, accelerating recycling programs, and even acquiring mining and processing capabilities. This shadow demand never appears in COMEX reports, but explains why physical inventories continue to drain while paper prices remain suppressed. There are real risks to monitor. Margin hikes can force liquidation, Bitcoin-driven risk-off moves can pull metals lower, geopolitical tensions may trigger a flight to cash, ETF structures may fail if physical metal is unavailable, and regulators can intervene to alter trading or delivery rules. Anyone claiming silver can only go up is ignoring these realities. Let's recap some key numbers. The Shanghai coordinated attack involved 6 account groups banned for dumping 674 million paper ounces. COMEX registered silver is 103 million ounces, while open interest is 429 million ounces. March delivery starts in just 3 weeks. Shanghai vaults are down to 350 tons, losing 15% in a single day. Physical settlement is 100% versus 1 to 3% normally. COMEX deliveries in 2025 hit 474 million ounces, more than double 2024, and January 2026 saw 49 million ounces delivered in what is usually a quiet month. China's central bank gold buying streak extends to 15 months. Export restrictions are trapping silver. Industrial demand is rising. Lease rates indicate shortages, and forward curves show silver commanding a premium over future delivery. Paper and physical markets are clearly diverging. The question isn't whether fundamentals support higher prices, it's whether paper suppression can continue long enough before physical reality overwhelms derivatives pricing. I want to hear from you. Are you positioned in physical silver, mining stocks, ETFs, or staying in cash? Your investment horizon matters. Long-term stackers view price drops very differently than short-term traders. Your strategy should match your risk tolerance. 3 takeaways. China has created a silver black hole with industrial demand, Shanghai premiums, and export restrictions draining inventories. COMEX March 2026 delivery is under mathematical stress, with 429 million ounces of open interest versus 103 million registered, and 3 recent margin hikes signaling exchange concern. Paper and physical markets are diverging dangerously, with Shanghai cracking down on manipulation, vaults draining, central banks buying gold, and industrial demand ignoring price signals. Time horizon matters. Invest logically, not emotionally. Don't follow anyone blindly. Share your thoughts on March delivery in the comments. Will COMEX navigate it successfully, or are settlement stresses coming? Your insights help shape future analysis, and I read every comment.